While most Western traders were asleep and one major Eastern market was closed for the weekend, the real world price of physical gold and silver kept living its own life. And when that market reopened into the chaos, the spread between East and West didn't just exist, it screamed. Let me translate that into plain English. You can have a screen price that says one thing, but if people in a major buying region are paying way more to actually get metal in their hands, that's not a rounding error. That's a signal. And it could be the beginning of a shift in who actually sets the price. Now, a lot of the chatter out there is obsessed with shock value numbers, massive local premiums, crazy retail pricing, and this storyline that the East is basically winning the pricing battle. We're covering the same events, same weekend energy, same spread story, but I'm going to explain it in a way that doesn't rely on hype, because the real story is even more dangerous and it has layers. First, what happened? We got a sharp move in gold and silver, a sudden collapse in the paper quote for silver especially. And then, while that was happening, buyers in parts of Asia were still paying up for physical metal like the discount never existed. That's the event. That's the headline. But here's the cliffhanger. If that spread holds, even for a short window, it creates a pressure cooker. And pressure cookers don't release steam gently. They pop. Now, I'm not going to mention any sponsor names, and I'm not going to tell you to click some random link, but I will tell you this. The description has bonus links, including a premium WhatsApp channel link and a channel membership join link. If you want alerts and extra material without hunting around, check those bonus links after the video. All right, back to the spread. When people talk about Shanghai versus London or East versus Comps, what they're really describing is two different worlds that pretend they're connected. One world is mostly paper contracts, leverage, and algorithms. The other world is physical demand, inventory, delivery schedules, and cultural obsession with metal as savings. And over the weekend, that difference got exposed because the paper side did what paper always does during stress. It repriced fast. The physical side did what physical always does during stress. It tightened up. Here's why that matters. When paper falls quickly, it can trigger stop losses, margin calls, forced liquidations, and a chain reaction that has nothing to do with real demand. It's mechanical. It's plumbing. It's like watching a building sprinkler system activate. Water goes everywhere, not because the whole building is on fire, but because one sensor got tripped. But physical demand doesn't care about your stop loss. Physical demand cares about one thing. Can I get it, and can I trust the currency I'm holding? And right now, in several places, people are asking that second question louder than ever. Now let's talk about those retail premiums, because this is where a lot of people get confused. They see a number that looks insane compared to the global quote, and they assume someone is scamming everyone. Sometimes that's true, but sometimes it's a very specific blend of taxes, distribution bottlenecks, delivery risk, and raw desperation. Think about it this way. If you're buying a metal bar through a local platform, you're not just paying for metal. You're paying for guaranteed delivery. You're paying for someone to have inventory. You're paying for the ability to convert savings into something outside the banking system. And when a lot of people try to do that at the same time, the premium becomes the price. That's the first big insight. The premium isn't always a bonus. Sometimes it's the true price of certainty. And this weekend, the market was selling certainty at a higher and higher rate. Now, here's the part that gets even weirder. Reports on the ground describe shops that were happy to buy back at the global price, but were selling at the higher local price. That sounds unfair, right? But it's also completely rational if you understand inventory risk. If you're a dealer and you think restocking is going to be hard, you don't want to sell your last ounces at a cheap price. So, you raise the sale price. But if people are panicking and dumping metal back to you, you're willing to buy at the safer, globally anchored price because you can flip it later, or you can hedge it, or you can simply rebuild inventory. So the spread isn't just a market difference. It's a map of fear and confidence. It's telling you where people are trying to escape currency risk and where people are trying to trade volatility. Now, let's zoom out, because the weekend move isn't the end of the story. It's the opening scene. The next scene is what happens when markets fully reopen everywhere, and those spreads have to reconcile. And here's the cliffhanger. Reconciliation doesn't always mean the East comes down to meet the West. Sometimes the West gets dragged upward, kicking and screaming. But will that happen here? Not automatically. This is where I'm going to challenge a popular assumption. A lot of people hear higher prices in the East and immediately conclude, okay, then the global price is wrong and the East will set the new benchmark. That's possible, but it's not guaranteed because there are barriers, real barriers, that slow down the arbitrage that would normally close the gap. Let me explain. In a textbook, if gold is cheaper in market A and more expensive in market B, traders buy in A, sell in B, and the spread collapses. That's arbitrage. But real life is messy. Physical metal has shipping constraints, customs rules, reporting requirements, financing costs, and sometimes outright restrictions on movement. Add in different purity preferences, different bar formats, and different taxation, and suddenly the easy arbitrage becomes a nightmare. So yes, the spread creates opportunity, but it also creates friction. And that friction is why the spread can last longer than you'd expect. And it's not just shipping and paperwork. There are hidden layers that make the same ounce of metal behave like a completely different product depending on where you're standing. In some places, the local street price includes taxes on finished bullion, fees for testing and authentication, and a premium for peace of mind because counterfeit risk is real. In other places, the real cost is time. If delivery takes weeks, buyers pay extra to skip the line. And sometimes the spread isn't greed at all, it's rationing. When inventory is thin, higher prices slow the rush. Then there's the currency angle. If you live somewhere with banking limits or restrictions on moving money, gold becomes a bridge asset. It's portable savings that can't be digitally frozen. So when local confidence wobbles, people don't wait for official statistics. They move first. And the premium you see is often a currency premium in disguise. People are paying extra to swap fragile purchasing power into something that feels sturdier. That's why a paper sell-off can create an optical illusion. Western screens flash a lower number, but the buyer on the street doesn't experience cheap. He experiences urgency. Now, you need to understand the plumbing, because this is where people get trapped. Most of the headline price we watch is a futures price. Futures are useful tools, but they're not the same thing as a bar in your hand. A futures contract is a promise with terms, delivery windows, specific locations, approved brands, and a margin system that can force people out at the worst moment. In stressed periods, plenty of contracts never become delivery. They get rolled, offset, or settled in cash. That doesn't automatically mean fraud. It means the system was built for speed and liquidity, not for everybody to demand metal at once. So, when you see two prices, one paper, one physical, it's not always a conspiracy. Sometimes it's the system doing what it was designed to do: absorb pressure through paper claims and limit how much real metal leaves the pipeline. Here's the cliffhanger. If enough people insist on metal instead of paper, the system has to adapt, and adaptation usually shows up as higher premiums, tighter delivery rules, narrower eligible product lists, and eventually higher prices. Product type matters too. In a lot of Eastern markets, buyers strongly prefer very high purity metal and standardized bar formats. In a lot of Western markets, coins and mixed formats are common. That changes liquidity. A dealer can be stocked in one format and empty in another. And don't sleep on geography. Regional trading hubs can act like bridges between time zones and between legal systems, pulling metal from one region and redistributing it to another. When activity spikes in those bridge hubs, it's often the first sign that bigger players are quietly moving inventory, and you almost never see that on a price chart. And here's a fresh layer. Silver's above-ground stockpile isn't evenly distributed, and a meaningful portion sits in forms that aren't easy to mobilize quickly. Some is locked inside industrial products. Some is parked in long-term holdings. Some is scattered among millions of small owners who won't sell unless the price gets extreme. So industrial buying can collide with retail buying and create a bottleneck fast. When bottlenecks form, the first thing that moves isn't always the headline price. It's the premiums, it's the wait times, it's availability. So if you're thinking, I'll wait for the perfect entry, ask yourself a better question. What if the perfect price exists only on a screen, but the physical product vanishes? And answer this in the comments. If the physical market and the paper market keep disagreeing, which one do you trust more? Your screen or your ability to take delivery? Now, Here's the twist. Friction is exactly what can change the market forever. Because if the spread becomes a long-term feature, not a one-weekend glitch, then you effectively have two prices, the paper price and the physical price. And once enough people recognize that, paper loses power. That's the danger. Now, why is physical demand so intense in parts of Asia? It's not just culture, although culture is huge. It's also policy. It's also demographics. It's also memory. In a lot of Western countries, people grew up in a system where banks generally worked. Inflation was relatively tame for decades, and the dollar felt stable. In many other places, people have lived through currency resets, banking freezes, capital controls, sudden devaluations, and rules that changed overnight. That history creates behavior, and behavior moves markets. So when the West sees gold and silver as an asset class, the East often sees it as insurance, not a trade, not a chart, insurance. And insurance demand doesn't disappear just because the screen price dipped. In fact, insurance demand often spikes when the screen price dips because people see it as a rare chance to grab protection cheaper before it vanishes again. Now, let's talk about silver, because silver is the one that can go from boring to violent with almost no warning. Silver is not just money metal psychology. Silver is also an industrial metal with a supply chain that doesn't flex easily. Mines can't just double output overnight. Refining isn't instant. And the demand side is quietly becoming a monster. You've got electronics, you've got medical uses, you've got grid upgrades, and yes, you've got solar. Based on recently published numbers, solar installations globally have been scaling fast, and silver is a key input in that industry. Even with thrift efforts trying to use less silver per panel, when volume grows enough, total demand can still rise. That's not hype, that's math. And here's the cliffhanger. If silver demand stays sticky while investment demand returns, the market doesn't have to run out of silver to explode. It just needs a shortage of deliverable silver in the places that matter. Now, the paper market can create an illusion of supply. You can trade paper silver all day. But when people want bars, when manufacturers want real ounces, when inventories get tight, the paper promise starts to look shaky. And that's why the spread story matters so much, because it's the physical market voting with its wallet. Now, I want to address something else many commentators online lean on. The idea of a war where one side is going to dominate pricing soon. That's a dramatic way to frame it. But the truth is, pricing power shifts slowly and then suddenly. So instead of pretending we know the exact day the baton gets passed, I want you to watch the signs, because the signs are already here. Sign number 1, recurring premiums in major physical buying regions, not one-time spikes, recurring premiums. Sign number 2, tightness in certain product types, specific bars, specific sizes, specific purities where generic supply doesn't solve the problem. Sign number 3, policy changes that legitimize metals as money again, even in small steps. And on that third point, let's talk about the United States, because this is another layer people underestimate. For decades, gold and silver were treated like collectibles by the tax code, like they were baseball cards. But states have been moving in a different direction, recognizing precious metals for payments, removing certain taxes, exploring systems where metal can be used in commerce. You might think that's symbolic, but symbolism becomes infrastructure when enough states participate. And if you want the fresh angle, it's not just the gold as money argument. It's the quiet pushback against centralized financial control. It's people and institutions looking for optionality, more ways to store value, more ways to transact if the system gets weird. Now, do I think everyone's going to start buying groceries with silver coins next month? No, that's not realistic. But I do think we're moving into a world where metal-backed rails and metal-friendly policies grow in the background while the public is distracted. And when those rails exist, demand becomes easier, which changes everything. Now, let's go back to the East-West spread and make it personal, because if you're watching this, you're not a hedge fund. You're a human being trying to protect your savings, build wealth, or both. So, what do you do with this information? First, you stop letting the screen price mess with your head. The screen price matters, but it's not the whole truth. If physical is tight, if premiums are rising, if delivery delays are growing, then the cheap paper price might be a trap. Second, you start watching the places where physical demand is most honest, not because you can trade it directly, but because it tells you where the real stress is building. And third, you recognize that volatility is a feature, not a bug in metals, especially silver. Now, I promised you cliffers, so here's the next one. The most important move might not be the price move. It might be the trust move. Because once trust shifts, once enough people believe the paper price is disconnected, then price can jump in a way that charts won't predict. That's why I'm watching not just price, but behavior. Are people lining up to buy? Are shops changing buyback policies? Are governments talking about reserves? Are industrial buyers locking in supply? From recent market updates, we've seen more central banks continuing to add gold over the last couple of years, even when headlines claim demand is slowing. The pace can fluctuate quarter to quarter, but the direction has been persistent. More gold as a reserve asset, less blind faith in someone else's liabilities. And that matters because central banks don't buy gold for fun. They buy it for control, for neutrality, and for survival. Now, you might be thinking, okay, gold has a bid, but what about silver? Silver doesn't get bought by central banks the same way. Silver's bid comes from industry and from the public. And when both show up at once, silver turns into a problem for anyone who is short, leveraged, or underhedged. So if you want a mental model, gold is the slow, heavy door that closes quietly. Silver is the window that shatters. Now, there's another layer here that most people miss. Currency stress isn't just a developing world problem anymore. In the West, the conversation has shifted from will inflation happen to how long until inflation cools. That tells you the baseline assumption changed. People now expect money to lose value. And when people expect money to lose value, they start looking for anchors, real assets, productive assets, scarce assets. Gold fits that story. Silver fits part of that story and adds an industrial kicker. But here's the counterpoint that keeps me honest. Metals don't go up in a straight line. They can drop hard, fast, and ugly. They can shake out weak hands. They can punish leverage. They can trap people who chase breakouts. So if your plan is buy because it went up, you're playing the wrong game. The smarter approach is to understand why you own it. Is it insurance? Is it speculation? Is it diversification? If you can't answer that, the market will answer for you at the worst possible time. Now let's talk about the spread again, because there's a specific scenario you need to be aware of. If the East keeps paying a higher physical price and the West keeps trading paper lower, what happens next? One possibility is that the spread narrows because the West price rises driven by export demand, inventory drawdowns, and arbitrage flows wherever they're possible. Another possibility is the spread narrows because the East price falls. Maybe policy changes, maybe demand cools, maybe the premium was temporary. But there's a third possibility, and this is the one nobody likes to say out loud. The spread persists and the world accepts two prices. If that happens, you have a global metal bifurcation. Paper becomes a separate market from physical, and then you start seeing consequences like manufacturers paying one price, investors seeing another, and global benchmarks becoming political. And if that sounds extreme, remember markets don't just trade supply and demand. They trade trust and access. Now, let me add some new context that often gets ignored because you need a wider lens. Right now, silver has been running a structural deficit in multiple recent years, meaning total demand has exceeded total supply, largely due to industrial use plus investment demand. Those deficits don't always show up in a dramatic out-of-stock headline because inventory and recycling can cover gaps for a while. But deficits are like termites. You don't notice them day to day until something snaps. And gold has its own pressure, not because we're running out, but because the holders are getting stickier. When long-term holders decide they don't trust paper assets, they don't sell gold easily. That reduces float. That makes price more sensitive to new demand. Now connect that to a world where government debt levels are enormous, interest expenses rising, and central banks are stuck between inflation and recession. That policy trap makes currency confidence fragile, and fragile confidence is fuel for metals. But again, cliffhanger, fuel doesn't ignite without a spark. The weekend spread might be a spark. A policy announcement could be a spark. A supply chain disruption could be a spark. A major currency move could be a spark. You don't get to choose the spark. You only get to choose whether you're prepared before it hits. Now, I want to do something that most videos won't do. I want to tell you what I'm watching next, step by step, without pretending I know the future. First, I'm watching whether retail premiums stay elevated after the paper market stabilizes. If the paper quote calms down but physical stays expensive, that's the market telling you the problem isn't volatility, it's availability. Second, I'm watching delivery metrics and inventory chatter. When you start hearing more stories about delayed shipments, rationing, or call for availability, that's a sign the pipeline is stressed. Third, I'm watching cross-market influence. Do Eastern price moves start leading Western price moves, or do they remain reactive? That relationship can flip over time. Fourth, I'm watching the behavior of regular people. When everyday buyers start treating dips as buying opportunities instead of panic signals, you get a stronger floor. And by the way, if you're successful, share your success story in the comments so others can stay motivated. Now, quick members note, because this matters for how we keep this channel running. We offer members only videos that are produced by a separate team with more research and more depth. Those extra videos are only for premium members. If you want the deeper dives and you want to support the work, the channel membership join link is in the description with the bonus links. All right, back to the market. There's another concept that got hinted at in recent market coverage: backwardation and tightness. I'm going to reframe it without the jargon. When buyers are willing to pay more to get metal now than later, it's a sign they don't want to wait. They're not just buying price, they're buying time, they're buying certainty. And when that shows up in silver, it's a bigger deal than in gold, because silver supply chain is more sensitive. Now, here's something else that's new. The industrial side has gotten more strategic. Manufacturers don't like being surprised by shortages. They sign long-term supply deals. They stockpile, they hedge. And once industrial demand becomes strategic instead of just buy as needed, it changes the entire rhythm of the market. That's not a guarantee of higher prices tomorrow, but it is a guarantee of tighter conditions during stress. Now, let's talk geopolitics, because a lot of people frame it as an East-West conflict. I'm going to be more specific. This isn't just about ideology. It's about settlement systems. It's about what gets accepted in trade. It's about which currencies get used, which assets get trusted, and who gets to freeze whose money when relations break down. When countries worry about sanctions, reserve seizures, or payment network restrictions, they look for neutral assets. Gold is the obvious neutral asset. It has no counterparty risk. It doesn't depend on a server being online. So even if you ignore the retail demand story, official demand for gold can keep building quietly for reasons that have nothing to do with charts. And that official demand combined with public demand creates a sturdier foundation. Now, silver doesn't have that official bid, but silver has a different ace. It's needed. If you want to build the future, renewables, electrification, data centers, advanced medical equipment, you need silver. And that means silver is tied to both fear and progress. It's tied to recession hedging and to growth investing. That's a rare combination. Now, the big question, does all this mean you should panic buy at any price? No, absolutely not. What it means is you should respect the direction of the underlying forces. You should respect the idea that the physical market can decouple from the paper market under stress. You should respect that silver can move faster than you think in both directions. And you should make decisions that match your risk tolerance, not your emotions. Now, let's bring the story back to that weekend, because the weekend is the trigger event. One market being closed created a temporary information blackout, and in that blackout, the paper market did its thing and the physical market did its thing. When the blackout ended, everyone had to look at the damage. And the damage wasn't just price. The damage was confidence. Because once people see two wildly different prices, they start asking a dangerous question. Which price is real? And the moment enough people ask that question, the market structure starts shifting. Now, I want you to picture a simple scenario. Imagine a factory that needs silver for production. They don't care about memes. They don't care about chart patterns. They care about delivery showing up on time. If the paper price drops, but the physical market is tight, the factory still has to pay up because they can't stop production. So they buy, they lock supply, they sign contracts, they pay premiums. Now imagine an investor watching the paper price drop and thinking, silver is crashing, I'll wait. The investor is thinking about price. The factory is thinking about survival. And over time, the facto's behavior can overpower the investor's hesitation. That's how tight markets break higher. But again, cliffhanger. Tight markets also create violent shakeouts because the system tries to flush out weak hands before it reprices. So don't be surprised if you see more fake outs, more sudden dips, more scary headlines designed to make you doubt what you see. Here's the simple test. If headlines are screaming, it's over. But physical demand is still paying up. You're watching narrative versus reality. Now let's talk about price discovery, because this is the part that can truly change everything. Price discovery is a fancy way of saying who gets to decide what something is worth. For decades, the West had the loudest microphone, mostly because of the biggest financial centers and the deepest derivatives markets.